Nothing wrong with a good old signature tune, is there, Stuart? That's one that we've been using for some time. Nice to bring it out of the archives. Today is an extraordinary day. We're going to be talking about, don't you like the headline? August's Rush. Did you ever see the movie August Rush?
I can't recall, Alec, unfortunately.
You can't recall. Well, it was a great movie anyway. But there was a good horse as well called August Rush here in South Africa. It was a Group 1 winner. But this has been an extraordinary month. As you can see from the headline slide, they're up 12% in US dollar terms in the portfolio in August for the month, pushed there primarily by Apple. We're going to be talking through the portfolio in a moment, but first up, do you want to get a text right?
Excellent, thanks, Alec. Always good to be here for the monthly update. I know everyone gets very excited. Just quickly, there's a little high five button on the control panel on the right-hand side. If you can see Alec and myself and hear my voice loud and clear, please let us know. If it's a bit soft, we can also adjust the settings. As you can see, I've moved into Alec's studio, so I've got adjustable settings now, Alec. I've worked on my sound.
You just need to bring that microphone a little closer.
I think.
Yeah, see the mic's got it's a sneaky little microphone that if you just take the top off and have a look. I want to have a look at something. Okay, do you see where you've got when you're going towards a circle, then it's 100%. So, but it's sneaky. It often with Tim Modise, he gets it at an angle and.
Okay, so there
we go. That's much better. You're very clear.
We also like to keep it quite conversational, Alec. Sorry for taking too much conversation up front, but there's a little question mark on your control panel as well. If you put your questions through there, I'll pass them on to Alec as we run through the portfolio discussion. But it looks like we're all good, Alec, and I see there people streaming in now, which is fantastic.
Fabulous. Well, this is for Biznews Premium subscribers only, and I look forward to. Let's just push it up a little bit. I see. Hopefully, that's. If you can give me some high fives, I know. Well, how do you get high fives? Hand raise. There we go. A little bit better with the sound. Thank you very much. Okay, we've got my sound right. We've got Stuart's right. Deborah says she can't see us. Stu, that's got to be something that.
That's probably an internet connection. Yeah.
Okay. And here we go. We'll go with the portfolio now that you've seen the two good-looking guys behind the scenes. We'll take ourselves off the screen. I'm glad our Biznews community members have got senses of humor. And of course, why not? Why not have a sense of humor today when you've had such an extraordinary run in your portfolio? And I hope those people who have invested in this portfolio from the beginning, that is from December 2014, can just remember that their investment in Biznews Premium has been the best thing they've ever done, because this portfolio has turned 2 million Rand in 2014 to almost 12 million Rand today. I mean, that's the real story of what's happened here. We have been very fortunate, and I'm not getting ahead of myself, as I'll show you a little bit later. We made a couple of missteps. However, generally speaking, the portfolio has done well, and we're going to be taking you through this extraordinary month that we had. Here's the story of August's rush. In July, the portfolio had broken through 10 million Rand for the very first time. In August, it's at 11.5. Sorry, I said 12 million, 11.5 million Rand. An increase in Rand terms for the month of 14.5%. And as you can see, almost 13% in US dollars, from up to almost $690,000. Reason for this, Apple up 38%. Now, you got to start worrying about this kind of a move in a single month for the most valuable stock in the world. It's worth more than $2 trillion. And the reason for the big increase was Apple became more accessible for small shareholders, particularly those guys who are playing the markets through the share market apps. I see Easy Equities have just brought out an app in South Africa. Maybe there's a little bit of a danger signal. But the app in the United States that has done very well is the Robinhood app. And it shows that people who have money and time on their hands, as the lockdown has given them, like to gamble. And it seems like they like to gamble on shares. We'll talk about Apple in just a moment. Very good moves, though, for Adobe, Amazon, Microsoft, and Discovery here in South Africa, which we bought at the bottom of the market in the same way as we bought Sasol at the bottom of the market here in South Africa. So those were two very big moves that we had on both of those shares. Discovery up by more than 10% in the past months. But the reason for that big jump in the portfolio in August is that stocks making up more than 2/3 of our portfolio. And as you can see, Amazon's 25% of our portfolio. Apple is now 19% of our portfolio, and the other three are significant as well, were in double-digit growth for the month. So you put that together, it's not surprising that the portfolio went up that strongly. I just want to dwell a little bit on Apple because it was up by 38% in the month. So there is a 20, well, in the month of our portfolio from the 28th of July. The reason for this was a 4-for-1 share split. Believe it or not, Apple actually cut its shares in a quarter, and the share price went up 38% primarily on the back of that. You might have thought that there was a possibility that the share price would have gone up about 12 or so percent in line with what happened with Amazon and Adobe and other similar stocks in the month. But the share split suddenly sent this into the atmosphere, into the stratosphere. And as you can see from this graph, on the 28th of July, the last time we did the webinar, Apple's share price was $93. It's now a touch under $130 in terms after the share split. So in other words, I've taken, what was it, nearly $400 on the 28th, and then divided that by 4, as is done. This, by the way, this graph is from the chart is from the Wall Street Journal. And at the bottom there is the money flow index. And as you can see, that's the red index. And that index is giving you a good increase as well. So there we go. Money flow index shows you money that's going into a particular stock. And there you can see it for Apple. Okay, moving on. Remember, the way that we invest in this portfolio is that we invest 1/3 when we do the US stocks. 1/3 in the first month, another third in the second month, and the final third in month 3. And the reason that we break it down into 3 is to try and take out the volatility of the Rand exchange rate. We started in July by adding Slack and 2U. Slack, which is a program that we use at Biznews very aggressively. It's a combination, I suppose you could say, of WhatsApp and email, but it can be done internally and kept very secure. Very, very popular around the world. There are tens of millions of businesses that use it. The competitor is Microsoft. Slack says that Microsoft is being using its competitive advantage incorrectly. They have launched some lawsuits against them. That's a side issue, though. Slack has been an underperformer relative to other exponential shares which dominate our portfolio, and we have been watching it carefully and have been buying into it at this level. It's actually gone up quite nicely in the past month since we bought our first 1/3. We're buying a second third now, and then the second third of 2U Inc., which is a online university teaching. It's the biggest in the world, the biggest tertiary online education business. And as you can see, we bought another 205 shares in that one. So those were the purchases in August, and this is what the portfolio looks like today. 25% of it in Amazon, 19% in Apple, Adobe, Microsoft, Naspers, and Netflix, all around the 8% mark. Discovery, which has come up to 6% now, and those returns are based on when we actually purchased the share in the portfolio. Wilson Bailey had a surge up to over 125 Rand a share. It's come all the way back now to 110, pretty much where we bought it in July, a month ago. The reason for that, presumably, is the offer that is being made for the Australian operation of Wilson Bailey by a Chinese organization seems to either have been withdrawn or have been rejected. But anyway, Wilson Bailey is a play on South Africa's long-term infrastructure story. Many people consider what Cyril Ramaphosa says as hot air. We don't, and I'd urge you to go and listen to the audiobook on Biznews. We are publishing a chapter a week. There's been a couple of weeks where we haven't published the chapters because of holidays and so on. But every week we've just published chapter 5. You can go in there, go and listen to that audiobook. There are 26 chapters in all. But as you get to understand more about Ramaphosa, you'll get a better understanding for who the man is. And it was no surprise to me to see him sorting out the hyenas, because if you consider his track record, it's all about dotting the I's and crossing the T's and doing things carefully. And the hyenas have been using their useful idiots in the media to propagate their views. And those views are, I mean, people are not stupid. South Africans, many of them might be poor, but poor people are not stupid, and we can see what the hyenas have been doing. I mean, I don't know if you saw Tony Yengeni being quoted in the Sunday Times calling for Ramaphosa to step down just after he'd been arrested weaving in the road in his Lamborghini. Now, how the heck a politician owns a Lamborghini is kind of open to question. Anyway, let's not go into that kind of nonsense, but it just tells you, I believe, that the infrastructure story for South Africa will happen, that Ramaphosa does things slowly, but he does them properly. Like any good lawyer, they know that the wheels of justice grind slowly, but they grind finely. Anyway, there's our portfolio. So as you can see, pretty nicely balanced, mostly in exponential stocks, but we do have some in South Africa. Wilson Bailey, which is there for the infrastructure story. Discovery, which we bought along with Sasol at the bottom of the market, 24th of March, because both of those look just ridiculously cheap. And you might recall that we bought Sasol at 28 Rand and sold it at 140 Rand. So that was a very good investment, or it wasn't an investment, it was a turnaround, but at 28 Rand, it was a ridiculously low price. And that's, of course, helped the portfolio as well. So all things being said, since the pandemic began, the portfolio is up 70%. And that was based on a view when the pandemic began and when we had money being thrown at the pandemic by governments around the world, particularly the US government, that when you put liquidity into the system, it increases the value of asset prices. And that just gives you an idea. From the beginning, we use compound annual growth. In other words, if the portfolio grows by 10% in year one, then instead of recording it from a base of 100, you now have to record it on a base of 110. And on that basis, in US dollar terms, the portfolio is up by 24%, which is pretty good going, and nearly 33% in rands. And it continues to outperform primarily because of the focus that it has on exponential stocks. However, it's very easy to start thinking that you know what you're doing or patting yourself on the back. But I'd love to put this graph or this chart up every time we have this webinar. And just as a reminder to all of us that although the returns we've achieved of 24% are amazing, we've had everything in our favor, including being able to buy Sasol at 28 and sell it at 140. And as you can see, the returns we've made on Amazon and now Apple have been spectacular. But Warren Buffett's done this for 54 years. We haven't even done it for 6. So you can just remember that sometimes you have the wind really blowing hard from behind. The S&P 500 index is 10% compound annual growth over the last 50 odd years. That's the kind of number that you should be aiming for. So at the moment, we're doing a lot better than that, but don't take anything for granted. The individual stock performances are really indicative of the reason for this portfolio's improvement. If you want to buy one Amazon share today, it costs you nearly 58,000 Rand. It's just extraordinary. And we've got quite a few, as you know, in our portfolio. Even Apple is going to cost you 2,166 after the share split. So it gives you an understanding of the value that the stocks have gone to. We look at Naspers in the South African market at 3,100 Rand of share, and we say, wow, that's expensive. But imagine that towards Amazon. Perhaps Amazon will now also do a share split, and you could probably see that do a 10-for-1 split even. And there's no news of it yet, but share splits, given the way that both Tesla and Apple have reacted to the share split, you've got to believe that the Amazon board are thinking along the same lines. Individual stock performance, there you can see Amazon way outperforming everything else. The reason we bought into Amazon in 2014 was really based on my own background in the digital field. I've had the good fortune of having been involved in digital media since 1997 when I started MoneyWeb. But the benefit that gave me was looking at the other players in the field and understanding, or looking at the market leaders in the field and understanding what they were trying to achieve. And Amazon has always been one of those companies that, to me, stands head and shoulders above everybody else in the e-commerce area. So when we watched and we saw the share price, it got down to $327 at one stage, and we bought into it when we began the portfolio. A very nice move in the last month by Apple has taken it into the second best performer, Microsoft. These are incredible numbers. And as I say, you've got to take a deep breath and just remember we're in a stage, we've had a very good run for exponential stocks, and that's where the portfolio is invested. They've all done well. Discovery is right up there, actually, if you take it on an annualized basis. And the reason for that is that we bought Discovery right at the bottom of the market, indeed, as we bought Naspers. Okay, so where to from here? Because I think that's really the big story before I start going to the questions. And the reason why I'm remaining very bullish and very positive about this portfolio, even though it has performed spectacularly well, is because an enormous amount of money has been created by the US government to overcome the problem of COVID-19. And when you have a look at this, I like to describe this as a python trying to swallow a kudu, rather than, as Ticho Mboweni, our finance minister, says in South African terms, the opening of a hippo's mouth. But this is the opening of a python's mouth. As you can see, this graph and a couple more come from Kevin Lings, the excellent economist who works for Stan Lib. And he sends out a pack of economic graphs every week that I watch out for, because he's got a good sense of actually showing us pictures that tell more than 1,000 words. And if you look at this, you'll see that increase in expenditure by the US government was done primarily in this respect to purchase government bonds. So what they've been doing is they've been pumping money into the system. And you can see how the graph shows you from 2009, after the global financial crisis there was a significant reflating of the economy, but it's nothing compared with what's happened in COVID, in the post-COVID world. Just go back there on that graph to 2009, take your eye along to 2011, even 2012, with those successive quantitative easing programs. And you can see what's happened now. And why the Americans can get away with this is the US dollar is the world's reserve currency. And for long as it remains the world's reserve currency, they can do this. They can create money out of thin air. But when they do create money out of thin air, it makes assets more valuable in the currency that they are creating. And there you can see the reality of this is that as you're buying more of these bonds, it's reducing the yields. And those yields, or the interest rates in the United States, not just there, but pretty much everywhere else in the world, are going to remain low for a long time, as we come out of this damage that the politicians have caused by lockdowns and all kinds of approaches towards COVID-19. Many approaches, of course, there's lots of debate around it, but I'm in the school that says if you look at what Brazil did, which was no lockdown, and what South Africa did, which was very tight lockdowns, the consequence for both of them of this viral infection was very similar. We have in South Africa had the very good fortune of having all had, I think, the BCG injection that has been universal in this country since 71, but has been administered to many people since the 1940s, must have played some kind of a role. Maybe it's our sunshine. Maybe we have more air. We don't really know why, but our death rate in South Africa is only 1/3 of that in other parts of the world. In the United States, they have a very high death rate, and as a consequence of that, they're continuing to pump money into the system. So I just wanted to show you those graphs. Of course, all bets could be off after November. And when you have a look at this, President Trump, who's been very good for the stock markets, he's got a mountain to climb. His approval rating, again, this is a graph that comes from Kevin Lings, is way behind that of his challenger and the Democratic Party's Joe Biden, who I have incidentally seen in Davos and really, really warmed to. He's that kind of person who whereas Trump seems to be a little bit aloof and bombastic. Joe Biden is known as middle-class Joe, and the problem for investors, however, is that Trump is the one who pushes investment prices, whereas Biden is one who's unlikely to be good for the markets. So we're coming up to November. It's going to be very interesting to see how things pan out in that election and how the market reacts thereafter. But it's had a lot of wind from behind up to this point. Just to put that finally onto the graph for you, or rather onto the page for you, as we go into some of the questions. And just remember, I know Stuart's been hit by load shedding. Hopefully he's going to be able to. Oh, you're back. Okay, Stu.
Yeah, sorry.
You're back with us.
Yeah, all good. So you want me to start with the questions, Alec? You finished up. Sorry,
Yeah,
I was waiting for you to finish it.
Just before you do, what is this portfolio for new people watching today? And I just want to outline that. This is for Biznews Premium members. This is a portfolio which started off as a Biznews Global portfolio, which we ran. We started it in December, on the 5th of December 2014. It is a model portfolio. It's not an actual portfolio. So you can't give money to Standard Bank, our partners, web trader, and say to them, put this money into this portfolio. It is a model portfolio. So the idea is every month when you come into this webinar, you get to see and you get to ask how your investments have been going. It's very tightly focused. We did at one point have this tightly focused portfolio on the Easy Equities platform where you could have invested in it. And in fact, it did so well, it was spectacularly successful that there was so much money that was flowing into it. I said to the Easy guys, look, I feel uncomfortable managing people's money because I'm not a money manager, an expert like John Bicard or these guys. We can't do this anymore. We will run a model portfolio, a notional portfolio. So the idea here is for you to invest in shares that are in this portfolio, all of them if you can afford to, or to select some of them, but it will open new investment opportunities for you. So that's what it's about. Stu. Hello, Stuart. Okay. Looks like Stuart's gone, so I'm going to be going into question here from Shoaib Kaji. Says, how do we invest into the Biznews portfolio, and is it too late? It's not too late, and the idea is that you will allocate your portfolio or your holdings into these shares. Now, the best way to do it is to use WebTrader, which is the Standard Bank's platform for international investing. I have a WebTrader account. I have some of these shares in that portfolio. I couldn't afford to buy Amazon at 58,000 Rand each. It just isn't within my compass at this point in time. So I bought other shares, and that's the way you can do it. Just split up your portfolio. What I would suggest you can do, if you've got 200 or 1,000 or so, is to try and replicate this portfolio by having your three bankers, which would be Amazon, Apple, and Microsoft, and then to take, and I would put 20% in each of those, and then I would take 8% into another 5 stocks, and those would be Adobe, Naspers, Netflix, Discovery, Spotify. You might go for Slack or 2U, which either of those you prefer. So that's really the way to pick it up. Shaib also followed up with a question to say, are you scared of a possible global market crash? I'm not, for the reasons that were given a little earlier on the from those graphs that I showed you, that there has been such money creation, as there's so much cash in the system, so much liquidity in the system, that right now a market crash of the type that we saw in 1987, or while always possible, doesn't look likely until after the US election, where we'll have to reassess, because it's like Donald Trump's hot air has been blowing the yacht that we're all on the investment markets very aggressively forward. Once he's out of the picture, it's going to be interesting to see what Joe Biden does. Lucien Deavis, I think is the correct way to pronounce it, says, is your POV, is in your POV the launch of Google Chat? Hey, man.
Sorry,
okay,
I'm
you back. All right, you go. You tell me the question.
Okay. I came to Santon and I was just getting hit with problems here, but it just says, in your point of view, with the launch of Google Chat, is it a threat to Slack? Obviously, the cost is $12 per user for a premium version, whereas on Google Suite, it costs $10 per user.
I love this question, because that's exactly the same question I was asked about Netflix, and exactly the same question I was asked about Spotify. And if you have a look at this portfolio, you'll see Netflix is up 101% since we bought it in September last year, and Spotify is up 90%, this is in US dollars, since we bought it in March. There's a fallacy that exists which says that the good independents, the small independents, will get wiped out by the big corporates. Now, maybe that's the case in China, where the government supports the big corporates. It's not the case in the United States for a number of reasons. First of all, the antitrust philosophy is very deeply embedded in the United States. And when a company gets too big and starts killing independents, the independents, as we've seen many times in the past with Google, well, you can go back to the 1920s with the Seven Sisters, that were created out of John D. Rockefeller's Standard Oil. It is a reality that the American politicians, and you could see a lot of this happening, by the way, after the November election, if Trump loses, where the Democrats have been vociferous in saying that they believe that big tech is too big. So that's a problem on that side. But I love backing independence, and Netflix was under huge supposed pressure from all of the entrants into the streaming of movies market, but it's continued to flourish. When you listen to the quarterly investor reports with Scott Hastings, the chief executive, and his team, they say they quite like the fact that others are coming into the market, because, and the likes of Disney and Apple and Amazon, because that expands the streaming sector. Their competitors, they say, are free-to-air television, not streaming. It's the move away from consumption by decree. In other words, the networks decide when they will put certain programs onto their channels, to consumption by demand. You get to listen, you get to absorb it or consume it when it suits you. Similarly with Spotify. Spotify was when they were attacked by Apple and the question when Apple Music came along was, well, that's got to be the end of Spotify. But Spotify reinvented itself and has invested hugely into podcasts, which are the fastest growing area of any media consumption. And they are also independent, run by, as is Netflix, run by Scott Hastings, a really bright guy. Spotify is run by a visionary called Daniel Ek. In the same way, Slack is being you mentioned here Google, but actually the real challenge to Slack comes from Microsoft. But in both cases, although the pricing might be an issue, Slack supporters are, and we wouldn't dream of using another option, even if it is a couple of dollars a month cheaper, because we're getting great value out of Slack and they keep improving the product that they have for us. So I love the independence. Tesla should have taught us that story as well. I'll share that with you. Our Tesla misstep in no doubt in this webinar at some point. But that's my story, Lucian.
Excellent, thanks, Alec. PG Exting's got a question on Discovery. He asks, does it have headwinds with the launch of the bank during COVID and then healthcare numbers coming down?
PG, it might. But I still think that Discovery is, first of all, we bought Discovery cheap. So we bought it at 67 Rand in March. So we've got our margin of safety there is enormous. I also believe that Discovery is not fully appreciated for its international footprint. Many investors have a look at Discovery on the basis of its South African, because it's a South African listed company, on the basis of its South African assets. But actually, this is a company that is very, very strong globally. Got a wonderful partnership in China with Ping An, where it owns 25% of the fastest growing and the biggest healthcare company in China. And what would that be worth? Who knows? But it's very undervalued in those kind of contexts. And I think when I look at Discovery, it's the kind of stock, as Warren Buffett would say, if you close the stock market for 5 years and came back in 5 years' time, would you still be wanting to own it? I would.
Thanks, Alec. Just you mentioning Tesla, Rick asks, having heard your rationale on Spotify and Netflix, what are the chances of you getting back into Tesla?
I love this graph because it keeps us humble. After Tesla's, there we go. So I've adjusted it after their 5-for-1 split. We bought the shares for under $40 relative current price in October 2016, and we sold it for just over $50. The reason we sold it 18 months later was that Elon Musk was just going wild. He was fighting with everybody from the SEC to the Saudis, who were supposed to come in and buy the company. And it was such a volatile ride that at the time, and it was a significant part of the portfolio as well, I took the view that Tesla was just too volatile for this kind of portfolio and sold out. Of course, it was a dumb view, as you can see. The price is now nearly $500 after the share split. So it's an 887% increase. And in fact, it would have been our second best performing stock in the portfolio had we kept it. Would I be investing back in Tesla at these levels? No chance. And the reason for that is that there's a lot of heat in this price. And the heat has been created by the Tesla fan club, and the Tesla fan club are retail investors. And when retail investors start piling into a particular stock or into the stock market as a whole, it is sounding a bell of caution. Now, the Tesla has to make cars to make money. Many of the companies that we have in our portfolio don't actually have to make anything more. They are scalable. With Tesla, it's always going to have it's a bit like a newspaper company. It has to produce a newspaper and deliver it, whereas to get 2 additional readers, whereas a online publishing company, it costs you nothing to service another customer. So once you get through critical mass in a exponential company like the type that we've got in our business, you've already got all your costs built in. With Tesla, they've still got to make cars. So no, I wouldn't be buying them at these levels. I think it's gone too high, but I've been wrong before. So if you love Tesla, be my guest.
Excellent, thanks, Alec. I just was told my sound was a bit soft. Is that a bit better?
I'll push it up a bit. Yep. Okay.
Perfect, thanks, Alec. James Tubbs just asked a question on the share splits. He says, given the ability to purchase fractional shares, or is this driven by perception? He says, how important are they?
No, in the United States, fractional shares are a very, very new concept. And most investors there would buy at least one share at a time. I know the fractional share idea has been pioneered here in this country by Easy Equities, and they've been doing it for quite some time. But in the US, it's still only catching on. I don't know, James. I mean, as a logical issue, if you have a share split, it should make zero difference to the share price. But this month, we've seen the share splits of Apple and Tesla have dramatically increased those share prices. Maybe the Americans are they think of things differently. Logic has gone out of the window, and that's another reason why we've got to be careful about some of these shares right now.
Thanks, Alec. Johan Nell just wants to know, what are your thoughts on Zoom? It announced last night that it doubled profits.
Yeah, that's one I missed. Warren Buffett has got 3 boxes. He says the first box is the smallest number of items in it, and that's the box for buy. In other words, the stocks that you know well and you've done a lot of work on, and you have a pretty good sense of what they are likely to achieve. The second box, which has got many more items in it, is sell or avoid. And those are those stocks that are too complicated for you, or you've looked at them and you really just don't like them. And then the third one, by far the biggest box, is too tough to call. Now that is where I would put Zoom. It's just too tough to call. Is the Zoom boom going to continue despite their security issues and despite a world that has to at some stage recover from COVID and normalize again? I don't know. It's just too tough for me to call. So sorry, I can't help on that.
Thanks, Alec. Mike Frost has a question on 2U. He says, can you tell us why the share price has been so volatile?
Yeah, it's been an interesting story to you. Remember, first of all, it's a very small company in relative terms, only a $3 billion company. Secondly, they have just gone through a rights issue. So Morgan Stanley underwrote the rights issue. They got the money in that they needed, was $380 million. And in the run-up to the rights issue, I'm not saying it, but sometimes it happens that share prices rise. Okay, let's just unpack that a little. When you have a rights issue of shares, what you're doing is you're issuing new shares to shareholders. So shareholders will buy new shares at a price that you want to be the highest possible, because obviously if there are 100 shares in a company, then you're going to go to 110 shares, say you increase your equity by 10%. You don't want to have the share price go against you, and then instead of only issuing 10 new shares, you've got to issue 12 new shares, and it dilutes you by more. I hope that kind of makes sense. So as a consequence, we often see in a run-up to a rights issue, we see the share price of a company rise, or what happens is that the share price of a company will rise, and then they have a rights issue because the people in the company feel that it is fairly valued, or in some cases even overvalued. A very famous example of this was before the 1987 stock market crash. Donald Gordon had the biggest rights issue ever in the history of stock markets in London for his Liberty International, and he actually raised a lot of money just before the market crashed, because the wise Donald Gordon had said these share prices are crazy, but if people want to throw money at me, I'll give them the opportunity. So rights issues are sometimes interpreted as negative. I think what 2U have done is very, very positive. They sold the shares at, I think it was $45, so it's at a premium to the current share price. And in fact, the shares went right up to 48 or so. And then they announced the price of the rights issue. It was underwritten by Morgan Stanley, who one of the big banks in America. And after the rights issue, the share price came all the way down to the to the mid 30s. It subsequently recovered a little bit from there. But that's the reason for the volatility. It's all to do with the rights issue that they had. It's behind them now. I would expect that the impact or the performance of that stock into the future is going to be based on its performance. But I'm quite happy that we've managed to buy our second tranche of shares at a slight discount to what we bought our first tranche at.
Thanks, Alec. Paul Jeffries wants to know, if one is already heavily invested in US tech shares like this portfolio, is it time to start putting new money into some S&P companies, alternatively a different geography such as Australia?
Paul, I don't know. What I invest in are in this portfolio, and certainly for my own investments as well, are in companies that I understand and that I can understand where their runway is. If there's a company like that you understand and you believe the opportunity exists for that business to continue to flourish or to do well in the future, and it's trading at a share price which is well below what you think the company is worth, then you must buy that company's share, become a co-owner of that share. For instance, if somebody came to me and said, I've got this manufacturing plant, I've got equipment in here that's worth 10 or say R1 million. I've got orders for the next 3 years, and which will guarantee me profits of R1 million, so we call it 300,000 Rand a month, 300,000 Rand a year, say, and I only want you to buy half of this company for R1 million, I'd look at it and say, well, I'll get my money back in 6 months. Yes, I'll be very happy to buy into that. And I think that's the big thing that sometimes we forget about. People fall in love with names. Certainly the small investors in America have fallen in love with Apple and Tesla at the moment, and some other shares as well, similar type of shares. Money is not sentimental. It's not emotional. It is an asset that you deploy like you would do in a business, where you allocate your resource to make the maximum return on it. And that's when you invest, particularly when you invest in equities, that is what you've got to be looking at. So if you do your homework and you decide that a company is sitting with a massive margin of safety, and that the share, in other words, the share price at the moment is at a huge discount to the value of that company, then you can buy. We've never in this portfolio bought into any oil stocks before, but when Sasol was at 28 Rand, it was a no-brainer. And that is why we bought it into this portfolio. But by the same token, when it got to 140 Rand, it seemed to us as though the future prospect had been discounted at that level.
Thanks, Alec. A follow-up from Johan. He just wants to know, what are your thoughts on NVIDIA and AMD? Do you feel they have growth potential?
NVIDIA often comes up in this discussion on this portfolio, and it's been a fantastic performer. And Johan, congratulations if you're a shareholder there, and to everybody else. It's one of those that I've just never, ever been able to get my head around. It isn't, it doesn't, it's like in that too tough to call area for me. I keep promising myself to read more annual reports and to read more about it, because it has been a phenomenal performer. AMD, I know, is David Shapiro's favorite. When I did have a look at the company, it seems to have a terrific business model. And no, sorry, I'm thinking of AMSL, I think, the Dutch company. AMD, I don't know which one that is, but there are many, many, many companies like that. And again, just getting back to what we said a moment ago, if you have done your homework, and that's the whole purpose of this portfolio, is to encourage you to do your homework, to do your own reading, and to make your own assessment. And if you get it wrong, whatever, we're never going to get everything right. But at least you've done your homework and you can learn next time round not to do the same mistake. It's like if you have a look there at our portfolio changes, I've learned a lot from this. And the obvious thing that jumps out at you, Tesla, Facebook, and Alphabet are three portfolio, which, okay, it goes back a while. I mean, Alphabet since 2014 has only gone up 50%. Oh, sorry, since we sold in 2019, it's gone up 50%. But when you have a look at the shares we've sold here, these are all exponential companies, including Tesla to a degree. Whereas the ones that we sold wisely, if you like, are non-exponential companies, in particular a couple of financial services businesses and IBM, where we followed Warren Buffett. So in future, I'll be very, very, very cautious before selling an exponential stock.
Thanks, Alec. Tebogo Malloy wants to know, will at some point you be looking at South African banks? If so, which are your two best SA banks that can outperform in the next 2 years?
Tebogo, I'm scared of South African banks. I'm scared of all banks. And as you can see from this portfolio, Barclays down 50% since we sold it in 2017, and Metrobank down 97%. So a big bank and a small bank that are both down very, very significantly over that period. So my view on all of this is very simple, that if you understand the business and you're comfortable with the business, then and you would like to invest in it, depending on your level of confidence, then do so. When I talk to the experts like Koki Koiman, who's really is the top banking analyst in South Africa by quite some margin, he likes FirstRand most. We did, I think, in the portfolio that we had with Easy Equities as South African champions, we had FirstRand there and it treated us well. It's a very good company. But I worry about banks because there's just so much competition, not just from banks within banks themselves, but from the whole ecosphere or the whole environment. It's not an area when you've got almost like a company that's guaranteed to grow at 20 to 30% a year, like a Netflix, a Spotify, an Amazon, an Adobe, Microsoft. Why would you go into a high risk area where they don't even know how much they're going to lose on COVID-19? They're estimating, they're saying to you, we've written off tens of billions of rands on likely bad debts into the future. When you've got when you invest in a bank, you have to do well, you have to have an economy that thrives and grows. Even the greatest optimist, and I'm a huge optimist on our country, has to understand that we've got so much to recover still from those 9 lost years. And Ramaphosa is doing the right stuff to move us in that direction, but it's not going to happen overnight. And as a result of that, banks are not going to be flourishing overnight, in my view.
Thanks, Alec. Harun just wants to know, with the Fed Reserve creating money, Warren Buffett has changed course a bit with buying into gold companies. Should we also not look at gold as a hedge against the Fed's raising of money?
Yeah, and I don't know if it was Warren himself. There's a bit of debate on that, because remember, he's got 2 portfolio managers who also have now an ever-increasing size of the chunk of the Berkshire portfolio that they manage. So it could have been one of those 2, but the reality is they've bought Barrick in a personal capacity. I have bought some Barrick shares. I don't think that this portfolio, though, lends itself to buying into inanimate objects. This portfolio is all about the bet on human ingenuity. And if you look at every single stock in this portfolio, it's to do with human ingenuity, perhaps with the exception of Wilson Bailey, but even there, you've got the best engineers, the best construction engineers in the country who are focused in that company now, the last blue chip, if you like, of construction. So gold is, you're not buying human ingenuity. The reason I bought a few Barrick shares is because I know the CEO pretty well. We were at university and we played against each other at school, and he's just a great guy, and sometimes you should support your friends as well. So not that he's going to worry about the few little shares that I've bought, but still, it's a recognition that the Buffett, the Berkshire Hathaway guys know what they're doing, and if they're prepared to buy Barrick shares, well, you can't be too bad. You can't go too far wrong, I think, in following them.
Thanks, Alec. Aresta just wants to know, would you continue buying Apple and Amazon if you had cash flow?
Yes, I would, but I would be doing them on the basis of not exceeding the percentages that we've got in this portfolio. So yes, I would. I'm a huge fan of Amazon's. Apple, again, it's a long-term story with Apple. It's based on the ecosystem that they've created, more than 1 billion devices. I'm an Apple nut, because if I want to transfer something from one of my Apple devices to another, I use a thing called, I think it's called AirPlay or whatever it is, but I can just press on the one button and it transfers it to the other machine. I don't have to go through, email it or whatever. And that's just a tiny example of how valuable it is for a user to be in the ecosystem. At Biznews, everybody uses Apple, and we're not going to move off it anytime soon. So Apple, to me, is has been undervalued for a long time. It's now starting, no doubt, with the incredible growth to get to a position of fair value. But Wall Street always used to calculate Apple's price based on the sale, get this, the sale per quarter of iPhones, which is just crazy when you've already got an ecosystem that is worth multiples of whatever you are generating from sales of devices today. I would be investing in both of those still.
Thanks, Alec. Michael Christelis wants to know, would you look at rebalancing the portfolio at any stage due to over-reliance on Amazon and Apple? So what do you think the impact of the legal challenge by Fortnite owners could be against Apple? Is it a big risk?
Michael, hey, you're far smarter than me on these things. But anyway, but my view on that, this portfolio itself is based on the Warren Buffett principle of your average holding period for a stock is forever. And that's what is going to happen here. Unless I make some real stupid moves, like with Tesla, the stocks here, we don't sell part of them off in this portfolio and then push to others. However, when Barry van Zyl, my a good friend, said he wanted to start investing in the global portfolio immediately a couple of months ago, what I suggested, and we did a podcast on it actually, and Stu, I don't know if it's easy enough to get that podcast, but it is available on Biznews. We said that rather do things differently, go in, again, I'm very supportive of Buffett's view that you have few eggs in the basket, but you watch the basket very carefully. And the way we worked it out there was that we would have 3 stocks of 20% each, Amazon, Apple, and Microsoft, and then 5 stocks from the rest of the list that he could acquire at 8% each. So that was the way to begin a new portfolio. Now, it's not that easy with Amazon sitting at 58,000 Rand a share. You have to have quite a lot of TOM to even make that kind of breakdown, because you're talking about you'll need 300,000 Rand in your portfolio to be able to get those allocations. But that, in theory, is the way to do it. If you can't put it in those proportions, then save money, and once you've saved enough, to put it forward. The whole story about Fortnite is absolutely fascinating. It is something that I read quite a lot of information from some really good insiders, and they're not so sure how this thing's going to break, but it is a fabulous challenge. In fact, there was an article in the FT weekend last weekend on the founder of Fortnite, which is well worth reading. I don't know how it's going to break, but obviously it is a risk, and yet doesn't seem as though the investment markets at the moment are taking it terribly seriously as far as Apple's concerned. Not when you see a 30-odd% growth in a month rather.
Thanks, Alec. I've managed to get that link. They're both on the chat, the Koeman and the Barry van Zyl interview for people listening. Graham Martin just wants to know, have you got any thoughts on BAT? Surely with the deregulation, there's opportunity for it to move now.
No, too tough to call. It's not my, it's outside my circle of competence. I stopped smoking 30 years ago, and thank God I did.
Thanks, Alec. Bruce wants to know, looking at the portfolio of shares from a zero base, and if you were wanting to add to the portfolio, which one would you choose for having the most runway?
Okay, from a zero base, I would say that you go 20, Amazon, Apple, Microsoft. The other five, to me, the ones that I really, really like are 2U and Slack. I think they're offering the best value. And then I also like Spotify and Netflix and Adobe. So there we go, pretty easy. Cloudflare is fantastic business, and we've done really well, as you can see, since buying in March this year. We've already gone up more than 50%, but it is a extremely highly rated stock, one of the most highly rated stocks probably in the world. And to get even more highly rated would be, I don't know. That's why I'm quite happy we only got 1% of the portfolio in there. But both Slack and 2U haven't really participated, and they should have in the strong run that we've seen. Spotify and Netflix go back to that story I was saying earlier, that I'll always back the independent, the small guy, relatively speaking, the market leader in a field, even though the giants are having a go at them. And then Adobe is a phenomenal business, which we were very fortunate to buy into in 2018. I think the world's starting to understand the value of having the automated model where we pay Adobe every month for the various software that we use. And it's a very, very powerful model for a business that already has a strong footprint in the areas, and dominance, in fact, in the areas where it has focused. So those would be my five, and then I'd have the other three. I wouldn't be able to tell you which of them are less rate or going to go up any more in the near future. I think that's really what one does with investing, is try and have a spread. And it always surprises you. I mean, who would have said Apple up by 38% in the past month? It just didn't make sense.
Thanks, Alec. A question from Christine. She says, if you're invested in SA banks, would you sell now at a low to buy tech stocks at a high with a longer term view?
No. If you're investing in South African banks, you've obviously done it for a reason. And if whatever your reasons were, unless those reasons change, then you don't do that. That's not what investing is about. That's trading. I don't understand trading. There are very smart people. In fact, we've got an advertiser on our site, CM Trading, who are very into that, and they know these trading strategies and technical analysis and all of that stuff. I just don't understand it. That's in my too hard to call box. My point about South African banks is it's not, and I was on the executive committee of a South African bank, a big bank, 20 years ago. The way that banks make their profits is the money they lend out, they get paid interest for, they pay back the people who they've borrowed the money from. There's some shareholders' funds that are also used to lend out to money, and there's a transaction benefit that comes through. That gives them their operating profit. But then below that, you get bad debt write-offs. So if you lend your money out badly, or if the economy takes a tanking, that's going to knock your profits six love. So that's a very, very big issue. And quite often people forget that banks are quite basic businesses at their core. But the real thing you need to watch is the bad debt write-offs. And the bad debt write-offs have been significant, or provisions for bad debts have been very significant in this latest reporting season. Are they enough, or are they going to be too conservative? I don't know. If the economy does not recover, if COVID-19 and the problems that have been caused for the South African economy by the lockdown and this extended lockdown that we've had is worse than people anticipate, and nobody really knows at the moment. So to me, you're just gambling on that. Would I be selling banks to invest in tech stocks right now? It depends on why I bought them in the first place. I think it all gets back to if I had fresh money, new money, I'd be buying tech stocks. That's what I'd be buying. I'll be taking it offshore, putting it into which I do. Amazon, Apple, Microsoft, and the companies I told you before. So much better to be investing in a company where you can see that their track record tells you that they'll be growing at 20% plus, than one where you really don't know what next year is going to bring.
Thanks, Alex. It looks like we've come to the end of the hour, but a question to end with from PG Eckstein. He says, are any other companies on your radar for possible buying in the future?
I did look, I mentioned when we bought Wilson Bailey that I did look at Afrimat and Italtal here in South Africa. Again, that play on the opportunities for South Africa with infrastructure. I think of the themes that have not been properly explored by investors, that's the big one. And that's done on the basis of all the noise that we're hearing and the noise that comes through, which talks about, well, Ramaphosa is going to get kicked out by the hyenas and they're going to destroy the economy and he doesn't know what he's doing, etc. I disagree with that completely. And I believe that he knows what he's doing. And I believe that he understands and his brains trust completely understand that this country needs to be investing heavily into infrastructure to get people back to work. So if that's the case, then the infrastructure companies will be the ones, and they are so bombed out, that will benefit. Now, both Italtal and Afrimat have moved a lot recently. Maybe some people are picking up that thought as well. In terms of market cap, when I put them next to Wilson Bailey, I would much rather own Wilson Bailey for about, I think it's about 6 billion than Afrimat at 5 billion or Italtal at 12 or 13 billion. So that's just the play there. But I do think that they all have merit. When it comes to the other companies that are on the horizon, I've been looking at many all the time. I keep seeing interesting opportunities, but there's nothing at this point that I would want to sell any share in this portfolio for to reinvest into those. We've still got one more line of investment coming through with Slack and 2U. What I would suggest is that you start to read about these companies that are in the portfolio and start to familiarize yourself with them. There's enough here that many other people have done the work on that you can start understanding. And from there, perhaps into the future, you can then make a more balanced decision when a new stock comes across your horizon. So I hope that's answered my very basic way of looking at investing. And as Warren Buffett keeps reminding us, and by the way, I will write the update for the 2016 book before the end of the year, definitely, because a lot's happened in the last 4 or so years. But he keeps reminding us that it doesn't take rocket scientists to become a good investor. It just takes a stoic. It takes somebody who's got control of their emotions. When we saw what happened in February and March this year with the complete wipe down, I wrote that in the Rational Perspective newsletter this morning that for our premium subscribers. When we saw what happened in February and March this year, there was panic and people just threw they threw assets away. Then since then, in the 5 months since then, we've had the best run for a stock market in the United States since 1938. And I think that kind of caps it all. So you have this massive sell-off because of the fear and then massive increase because of greed. Somewhere in between the middle is where we should be. This portfolio has had the very, very good fortune of being invested in stocks that are well positioned for the future. It's now had a big injection and a big support from the governments around the world, but particularly in the United States, who've created money to offset the damage they've caused through lockdowns and other regulations that happened during the COVID-19 panic. Remember, in our country, they were talking about 300,000, 380, 350,000 people dying. There were some estimates that took it up to as much as 2 million. It's likely that we might come out at under 20,000. Now, when you have created that kind of fear in the public, it has consequences, it has impact on businesses. And then governments need to do something, as they have been doing, to offset the impact of their mistakes. That's the way you look at it as a rational person. And as a rational person, when I look at the scenario that we have in the future, we have been creating an enormous amount of money in global markets. And when you have more money, economics 101, more money chasing the same number of goods, and we're talking in this case the same number of stocks on the market, then the value in terms of that money of the stocks on the market are going to rise. So real basic, simple stuff. Just get away from the emotion if you can. When you see another Sasol sitting at 28 Rand a share, surely the decision then is to buy it. But I can tell you, when we did that, we had lots of people who were criticizing. I get lots of emails from very smart people, obviously, because there were many of them who were calling me an idiot at that stage. And I think we were quite bullish on Sasol all the way down from around 70 Rand. And for a period of time, sure, looks real dumb. But you've got to take emotion out of it. Have a look at what you believe and what you understand a particular stock is worth, the intrinsic value of that share, and treat it like you're buying a business. If a business is offered to you and you understand that business and you know that the return you're going to get on your money is relatively safe and is going to be higher than you would get elsewhere, well, then it's logic that you should think of investing in it, despite what the neighbor or the guy at the golf club might be telling you about it. Just try and get the emotion out of the issue. Do your own homework, and you'll be a good investor.
Lovely. Thanks, Alec. I think we can leave it there. Thanks as always. I know we'll be back the last Tuesday of September. Sorry, this one was a week late, but I think you needed your R&R, Alec.
Sure. Someone was saying yesterday, Mark Barnes, the inimitable Mark Barnes, was saying in the Rational Radio webinar on Monday, I said to him, I'd met Priya at Champagne Sports Resorts, and she said, wow, she thought that the whole Kisby fund was a great thing. And Mark Barnes said, well, the Drakensberg Air certainly does do something in opening people's minds and getting the brain cells working better. So hopefully it's done that a little bit for me. But yes, thanks, Stu, and thanks to you and Jackie and the team for holding the fort and giving us the opportunity. It's quite nice in a growing business where you do get to the point that you can really just leave and things keep going even better. So it's been great. And it's, as always, thank you to everybody who's on the webinar today. It's been a pleasure. It always is a pleasure. I'm sorry we didn't get around to all the questions, but I'm sure we'll have an opportunity next month.